Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review a relatively common scenario that you wouldn't think is common for the most part. And there are a lot of people out there, right, who think, "Oh man, if I make six figures, my life will be sweet and my life is going to be set," right? You ever hear those people? Maybe you are one of those people. And if you are, I'm not criticizing you. But what we're going to go over is a person who makes decent money, over six figures, and is living paycheck to paycheck. And in fact, this channel is one of the main reasons why I've been in contact with so many people who reached out to me and say, you know what, I make good money, but I'm drowning, right? And I remember once upon a time, a long time ago, I was making $20,000 a year, and I remember like being thinking like, if I made 50 grand a year, my life would be so set, right? I don't even have to make that much. But I don't understand how someone who makes over six figures, why would they be broke? And I remember hearing a story about a plastic surgeon who made over $500,000 a year and had to pack his own lunch because he was broke, right? And unfortunately, the more money we make, the more expenses just are magically creep up. And if you want to look more into that, there's actually a phenomenon or a law called Parkinson's Law with money, right? The more money you make, the more your expenses just creep up, right? And that's what happens to a lot of people who make good money. So what we're going to do in this video is learn how to pay off debt using velocity banking, right? And this person has five credit cards, one, two, three, four, five, and a mortgage of 200K. And our objective is to pay off the $93,000 of credit card debt. And then once we're done paying off that debt, then yeah, we'll go ahead and tackle that mortgage. But as you can see here, we make really good income, 6,500 a month. But look at all that, those expenses, and what do we have here? About $186 in our savings. And so if you're in that situation, or if I were in that situation, I would just freak out. I'm like, what's going on? What am I doing? Right? Now, luckily, we'll just assume this person, because he or she or whoever has a mortgage, we were able to get a home equity line of credit. And I don't know if you ever heard the saying that banks only lend you money when you don't need it. You ever hear that before? So usually when you want lines of credit or credit cards or whatever, get it at a time when you don't need it, right? And again, this isn't me giving you financial or credit advice. This is just letting you know of stuff I've heard throughout the years that you may or may not want to apply. I don't know. But this person luckily owns a home and is able to get something called a home equity line of credit. Now, before we actually get into the meat and potatoes of this strategy, let's just quickly review the two things that we need in order to do velocity banking. So I'll just say requirements, and we always review this in every single video. What are the two requirements for doing velocity banking? So number one is the budget, and number two is your line of credit as your main operating account. Now, luckily, I've already done the first part of the budget, right? So you can see here we have an expense breakdown, and every time we do an expense breakdown, we have to make sure that we list every single debt that we have, right? Every single debt on its own line item, because every debt is eating up cash flow. And once we pay off debt, we get more cash flow. It's that easy, right? Now, the second requirement is that we need a line of credit. So let's just assume that, maybe a whiles back, we got a home equity line of credit. And if you don't know what home equity is, all it is pretty much the price that you could sell your home for today, minus the debts that are tied to your home. So if your home, if you put a for sale sign on your home, let's say you live in Southern California, your home would probably go for at least $1 million, right? And then let's say you have $700,000 of debt. Your equity is just your home sales price or estimated home sales price minus your debt. So it's about 300,000. Okay. And what banks will usually do is they'll lend you 80% of your equity in a form of line of credit. But yeah, so let's just assume that for this example, that we were able to get a $100,000 line of credit. Now, I know some of you are thinking, wow, that's a lot. And some of you might even think, well, that's a little, right? I have had two home equity lines of credit, and when I first applied, I only got 15,000, but I got that home equity line of credit like right after I bought my home, right? And then 1 year later, I applied for a new home equity line of credit with the same bank, and they lent me up to $50,000. So think of this as like almost like a credit card based on the value of your home, right? So let's just assume that this person has access to a $100,000 home equity line of credit. Okay, so this will be our main operating account. Now, Our assumptions are this. We're going to have the same income, right? Now, here's the thing about velocity banking versus your average American. Average American pays everything from, your checking savings, right? That's their main operating account. Whereas the person who does velocity banking, what's their main operating account? Everything is done from the line of credit. Like if you don't have any debt, you don't need this, right? But if you do have debt, that's going to be your main operating account, which is your line of credit. Okay. So now what we're going to do is we're going to do some debt consolidation, just transfer some debts to free up some cash flow, right? So this is going to be a relatively easy process because here's the thing. If we have a 10% line of credit and we move all this credit card debt, you have interest rates from 30, 29, 27, 30, 20, right? And we move it all here. Guess what? That's a big win in two ways. One, we free up all this cash flow, and you'll see what I mean by that. And number two, the interest, if we're moving 30%, 20% lines of credit cards into lines of credit, we're just not accruing as much interest, right? So two ways it's a win, okay? Now what we're going to do is we're not going to pay off this mortgage, and it's going to be a little bit hard to pay off because it's 200,000 and we only have $100,000 line. But what we're going to do is leave this mortgage alone until we pay off all these credit cards. In fact, this is one of the more easier scenarios of velocity banking. So let's just imagine that I have this home equity line of credit and I applied for it, and maybe I listened to someone like Susie Orman. Like, you ever listen to Susie Orman? I think she hates home equity lines of credit because she's like, well, if you don't pay it off, they could take your house, right? Well, duh, right? Because it's secured by your home. But anytime you secure anything um, with an asset or collateral, you get lower rates and higher limits. That's just how the lending world works, right? So, there's no such thing as a free lunch. Just remember that. So here's the thing. Let's go ahead and move all these debts, right? So move all these debts. It's 93,000. In fact, let's just verify right now. 20 plus 25 plus 28 plus 15 plus 5, and it'll tell me how much the balances are in total, 93. So we summed all of this up, $93,000 of debt. So let's go ahead and do this. What we're going to do is transfer all this debt to the home equity line of credit, and then look at what happens, right? So once we paid the credit cards or transferred the credit cards, guess what happens? Zero, 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 bam, right? And now look at what happens, right? We freed up some relatively good amount of cash flow within one day. So $3,000, right? Look how easy that was. I just did this in one step, right? Just one step. Just by doing one simple transfer to that home equity line of credit, man, that was simple, right? So now this is month zero, and if you don't know the strategy, we're not going to have any savings in anything in our checking and savings, right? Because the entire strategy is you put your entire income into that line of credit, which does two things. It satisfies the minimum monthly payment and it minimizes the interest, right? So you're going to put your entire paycheck into the line of credit, take your expenses out. Now here's the thing. This is a little bit more easier. I wouldn't say more advanced, but you could actually use a credit card for your general expenses, like your all the other stuff. And I should be a little bit more specific here: food, gas, insurance, etc. Right? And what I could do is just use one credit card as my main charge account so that I don't accrue interest, because what the disadvantage of using any sort of personal or home equity line of credit is that when you pull out money, then interest accrues the next day, I think. I don't know if it's the same day or next day, but interest accrues when you pull out that money. But with the credit card, when you charge things into your credit card, um, you don't accrue interest if you pay the statement off in full. So what you do is you would pay off that credit card every single month at the last possible moment before the entire statement balance before it's due, right? At the last possible moment in order to delay the interest. But that's a little bit more actually the strategy is simple, but a lot of people don't get the explanation at the very beginning when you tell them that. But we're going to make this simple and are assuming that we're not going to use the credit cards for now. So 93,000. And so this is how we do it. So this is what we're going to do. So month one, we're going to take the previous month's balance. So that's J2. And actually, let's include the interest, even though there's no interest in month one, HIJK2, right? So what we're going to do is combine these minus our cash flow, 3308.9, right? And then now what we're going to do is we're going to calculate the interest, right? So the interest is you're just going to take the average daily balance. Now, it's a little bit hard to calculate because, or calculate accurately because you don't know what the average daily balance is because that's like predicting the future, right? You don't know when you're actually going to spend money or go to the groceries and cause the average daily balance to fluctuate. But what you can do is just maybe take the midpoint of these two numbers and use the average function, multiply it by the interest rate, divide by 12. So zero point 0.1 is the same thing as 10%, and then you divide by 12. Why do we divide by 12? Because it gives us the monthly interest, whereas this interest rate here is usually quoted APR, annual percentage rate. So you got to take that into account. And then once we've done this and we've done this, then guess what? All we got to do is just copy and paste, right? We just copy and paste, and then we just kind of wait for this to go zero or negative, right? And take a look at that. So this is where we stop, right? So now let's see how long it took us to pay off $93,000 of credit card debt. Yeah, $93,000 of credit card debt. So let's go ahead and do that. All right. Whoopsie, I screwed up. Yeah, I did. So let me just do a quick formula. L3, whoopsie, L3 plus 1. And I'm going to go ahead and copy and paste. Yes. And it takes us about 32 months to pay $93,000 of debt, right? So let's go ahead and put a milestone here. Let's put some milestones. Milestone. And so 93K we paid off in 32 months. Okay. And we just copy that because these are the total combined debts. Okay. And what we're going to do is since we've paid off all this debt, then let's go ahead and tackle the mortgage, right? That's pretty sweet. But let's just assume maybe we refinance this mortgage or got a brand new one. I don't know, but it just makes the situation easier to understand. But let's say that we got a brand new mortgage at $200,000 at 6%, and I have this amortization calculator right here that tells you how much you pay throughout the life of the loan. And if you don't know anything about mortgage math, when someone tells you you have a 6% interest rate, you're actually paying 112% interest after 30 years. So if you take a look here, 6%, how much are you paying in interest? $231,000. So that's actually more than the loan. I don't know if you knew that. I didn't know that when I first learned this. I was like shocked. And then I realized because of this number, that's why banks have the highest and tallest buildings in every single downtown, right? These things are money makers, right? And think about it. And this is just off of one person. Think about all the millions of people in this country who have mortgages and they're just giving streams of payments to the bank over time at 112 interest in total, or 112% interest in total. Isn't that insane? All right, so now let's see how many years is 32 months. So equals 32 divided by 12. So about 2.6 years, not bad. $100,000 of debt in 2.6 years. That's pretty good, right? That's pretty good. All right, so now what we're going to do is we're going to figure out what the balance of this loan is at $200,000. And let's go here. Let's do a monthly schedule. So this will be 32, right? So 32. So 193. Do you see that? So you only, after 30, about 2 years, you only paid about $7,000 of the loan, right? So let me go back to 32. So it's about 2.5 years, but let's see how much we paid in interest after about 2 years. So it's about 11, 11, and then we could probably say it's in 5. So 22 plus 5 is 27. $27,000 of interest. Ugh, disappointing. All right, so let's go back here. So 32, let's go ahead and copy this. So this is our new balance right now. All right, and we'll just go in here. All right, so $193,000 Now, here's the thing. This is what we can do. If you have a loan, and this is, we're actually kind of getting into somewhat a little bit more, I don't want to say complicated, more in depth with this because if I don't know if you ever heard of the cash flow index, but I always consider it a ranking system which loans to pay off. But basically, all it is a measure of how much loan there is compared to a payment, right? And I'm just gonna all it is a formula of the balance versus the payment. So for example, I know we already paid this off, but I'll show you the cash flow index here. So equals 20,000 divided by 700, right? And actually, let me make this easier to read because all those digits don't make it easier to read. So we'll say two decimal places. Okay, so now this one is $25,000 divided by 854.17 and equals 28,000 divided by 910. And then this one is 15,000 divided by 525, right? Again, statement balance over monthly payment, 5,000 divided by 133.33. Okay, and then this one, what's the cash flow index here? Divided by 1191.1. Okay, and there's a explanation if you ever go to the Wealth Factory's website by Garrick Gunderson. The explanation is anything under 50 should be paid off, right? And anything over 100, you should wait to pay off last. But again, um, this is why we tackle all these debts first, right? Anything under 50, we just pay off as soon as possible. This one, yes, we do want to pay off because of all that interest that accrues throughout the life of the loan. But here's the thing, anytime, in my opinion, and I'd have to kind of flesh this out a little bit, you have a loan that's like over 50 or over 100. The easiest way to pay this off is what I call chunking. And so what you do is just transfer parts of this loan in whatever your paycheck is. So if I take 193,000 and subtract 6,500 or move 6,500 to the line of credit, and let's go ahead and do that plus 6,500. All right. And then just do this over again until it goes to 0, right? So let me go ahead and do this plus 9. And we're gonna, right? So you see after 33, 34, 2 months, we paid off 6,500, right? After 2 months, okay? And then, so what's 193? Well, and let me just do this quick calculation here. 19300 minus 6,500. Oh, this is right. I need an extra 0 here. 193,000. What is the now the balance? And then you just keep rinse and repeating over and over again, right? So I was at 193. If we follow the bank schedule, how long does it take for us to get to 186,500, right? So we got to take a look at that. So 186 is actually going to take us about maybe um, probably at least another year. So at year 5, so it takes us 5 years to get to 186,000. But by just moving it to the line of credit, you have an easy way where you could just dump all your money in and then just pay off chunks of the principal while still maintaining your liquidity. So how easy is that, right? And so what we're going to do, and again, this is just a little bit cowboy math. I actually have a more accurate calculator, but what I want to show is here is that you don't need a super accurate calculator to figure this out, right? So 186, 500, and then what you do is you divide by, let's say 6,500 to figure out how many times you can pay off the principal, or you would need to pay off the principal in 6,500 chunks. So that's going to be 28.6 times, right? Or 28.7 times. Let's just say 29, right? So 29 times to pay off 6,500 chunks, okay? And then it takes us about 2 months to pay off that 6,500, right? So what's 29 times 2? That's 58. Okay, so divided by 58 divided by that well that's 58 months. So 58 divided by 12, what's that? 4.83 years. So again, this is a little bit of cowboy math, but let me just do this. So 58, so what we're going to do is just say 293K, and then what's 58 plus 32? So equals 58 plus 32. That's 90 months, right? 90 months. Okay. And then bam, this goes to zero, right? Now look at our cash flow, 4,500. Oh my goodness. And so how long is 90 months? So equals 90 divided by 12, 7.5 years. 7.5 years to be completely debt free, right? And now we have $4,500 in cash flow. Look where we were before, $186 a month, and we're drowning. Like it feels like we're hopeless, but just by doing one simple transfer to a line of credit, now we can breathe, right? So now we can breathe. This goes to zero in about 31 months, right? Or 32 months. And then we just, after every 2 months, then we just pay off that principal relatively quickly because all of our other debts are paid off to the loan. Okay, so hopefully that made sense. But yeah, this is relatively easy, right? So again, this is a relatively common scenario where a lot of people, yeah, they make good money, but they just don't know how to manage it, right? It's like driving, having a lot of money is like driving a nice, I don't know, sports car. I don't know if that's the best analogy, but you just don't know how to drive it, right? And it's the same thing with real estate. Just because you own a rental property doesn't mean you know how to be a good landlord. Same thing with just making a lot of money. Just because you make a lot of money doesn't mean you know how to manage that money well. And there are a lot of people out there who are in this position, more than you think. All right. But yeah, so this is it. Paid off 300K debt in about 7.5 years, and good to go. And if we never, hopefully, we never tackle on that debt again, and we're good. Other than that, all right, that's it for today. Have a great day, and hopefully, we're not drowning in debt anymore, or we have an idea how to get out of debt if we're drowning in it today. All right, awesome. Talk to y'all. Actually, before I actually end this, always want to make a plug for the group. So if you're interested in joining our group and want to learn about real estate investing and financial literacy, more about financial literacy, go ahead and click the Google form link below, and then we'll get on a one-on-one Zoom call. Okay. Other than that, have a great day, everybody, and I don't know, cheers if that's the best way to end it, but cheers.